All right, good morning. Today is Thursday, November 21st, 2024. Welcome to this month's Capital Markets Update and Outlook call. We are live on our website as well as all of our social media pages. If you are with us live or if you are watching in the recording, thank you for taking some time out of your busy schedule to be here with us today. If you are joining us for the first time, my name is Eric Hagan. I am a financial advisor. I am also president of Capital Consulting Group, or CCG. CCG consists of myself, of our Chief Investment Officer, Tom Fox, who we will all hear from in just a couple of minutes. We also have financial advisors Dan Oshman and Rana Grant, and our growing client support team of Josh Denny, John Knutson, and Maryland Westmark. Josh joined us here just about a month ago, so if you have an opportunity to talk to him, welcome him to the team, please. We are very excited to have him with us. Together, our goal is to help individual investors make their next financial decision and the one after that a good one. Today, we're going to hear from Tom Fox. Tom will review the positives in the markets, the headwinds, and give us his outlook for the rest of 2024 and into 2025. Ultimately, this is your opportunity to kind of look over our shoulder and get an idea of what we're seeing in the markets and the economy and what we're watching for. So I encourage you, if you have any questions, to put them in the chat box wherever you're watching from, and I will review them and bring them up to Tom at the end. Alternatively, if you prefer, you are more than welcome to email me. My email is eric@investwithccg.com. You're welcome to email me, and we would love to address any questions that you have that way as well. Tom spends all of his time more behind the scenes doing market research, due diligence, running different analyses, and really focusing his attention on the economy and the markets. Tom has close to 40 years experience building investment strategies. He has an impressive long resume, and as always, I'm very excited to have him here with us today. Again, at the end of today's message, I will open it up for Q&A. So if you're watching online, whether live today or in the recording, please feel free to post your questions in the comments section. I do watch those. I do get those. And again, you're also invited to email me directly as well. Would love to present those to Tom if you're live with us here today, or later in the recording, would love to circle back with you. So with that, I will bring our theme up for the year and bring Tom in to the stage. So Tom, I think you're on there with us today. So welcome.
Good morning. Thank you very much. Hello, everybody. I'm excited about our presentation today. And our theme has been for 24, the times they are changing. Of course, that's a Bob Dylan song. And we'll talk more about that. We haven't seen as much change as I was expecting, but we have seen some change. And then, one of the big changes we saw was Republicans taking the Senate, the House, and also obviously the presidency, which is very interesting. And we're going to see how that unfolds as we go into 2025. So I always like to start off with the wall of worry and uncertainties. And there's plenty of them out there. Some are the same, some we've adjusted or even added a few. But probably the one that has been there for a long time, which is the Iran-Israel potential. Now, remember, Iran is still claiming they're going to attack Israel and they're going to really make them hurt. That has not yet happened, but it could potentially lead to an all-out war. Now, right now, Israel, through their military ability, has the advantage over Iran and all the proxies. So Iran is a little fearful of Israel. If you probably remember, Israel went in and took out a lot of their defense in Iran, but they've also been able to take down most of the Hezbollah offense and also obviously Hamas. So all these proxies, including Iran, Israel has got the upper hand at this moment. but there could end up being escalation. So that would be difficult for markets, potential of oil or other things spiking. So that's in the potential cards out there. Now, another one that's now heating up, which is an old one, which is the Ukraine, Russia, that's starting to heat up today. And it started when North Korea started sending troops over to fight on the front lines with Russia. And so President Biden had decided to change his policy on what Ukraine can use regarding the missiles that are given to Ukraine, the longer range missiles. And so he is given the green light to go ahead and shoot into Russian territory. We believe this is a dangerous escalation, and it could be day to day to see what happens. But we got to see what the response of Russia is going to be, because Ukraine hit a weapons building that had something like 14 or other explosions that went off along with the initial explosion, and has sent another missile in from the Britain, sent another missile in. So now they're both, Britain and the US, are allowing Ukraine to shoot into Russia. And this could definitely cause some issues. Now, the first announcement of the first explosion, what happened? Stocks started coming down and treasuries started rallying. Now, it didn't, because nothing unfolded post this explosion. But what it shows is that if this begins to heat up, that most likely treasuries are going to rally and stocks may be vulnerable. Now, China, that's been an ongoing issue. They're struggling to get their economy back on track, and they're trying stimulus, but it's still struggling and has not done what they're expecting. But that is this ongoing battle for the Chinese to turn their economy around. And especially with President Donald Trump coming into position, which all his policies will most likely take exporting from China and send them somewhere else, because he's going to use tariffs and other things to equalize it. I believe he's probably just using the potential for tariffs as a negotiating point. But we'll have to see how that unfolds. Now, what's interesting, Target company right here in Minnesota and other retail stores are starting to experience budget-oriented consumer. Target just dropped 21% yesterday when they reported their earnings and revenues. And what they see, their forward guidance, is that the consumer is starting to get more and more selective and pulling back. Now, what that means is that if this continues, that we could have a very weak Christmas retail experience. And of course, if that happens, it could trickle down and end up touching employment, which we'll talk more about later. But this is a new thing that just happened, where Target is now seeing the consumer getting really stubborn on what they're buying. Also, we've mentioned before the last month that the credit card auto loan delinquencies are at levels where we normally see a financial crisis. Normally, this is mostly in the lower income areas, but still it's rising. It's not getting better. And here's another one. Stocks are no longer cheap. The forward PE ratio is around 22 or slightly over as of today. And so this is an expensive stock market. And we're going to look at a chart on this to see that this is typically, we're getting very close historically when things start to roll over in the stock market. Another thing that's been happening is that bond yields. We're going to talk about bond yields today. They've been rising again, which if they continue to rise or stay high, that eventually puts pressure on stocks, which is a negative. And I think also because the economy has been so resilient up to, let's say, the announcement of Target, what's happening is the Fed cuts may come in slower than expected. Powell in his last speech talked about they're in no hurry to lower rates. They're still on track. They're still dovish. But the question is, are they going to slow down the rate cuts. And of course, that will keep bond yields higher for longer and maybe even impact stocks. Of course, we've had this in here a long time, but historically, most Fed interest rate campaigns end in recession. We'll see what happens here in this one. We thought a recession would come sometime this year. It obviously hasn't yet. In fact, every strategist that I know, the economy has blown them away in terms of its resilience. I don't know if you remember, but most strategists at the beginning of the year, including us, had a range for the S&P to end this year at 4,400 to 5,200. Well, it touched 6,017. We were at the high end at that 5,200 at year end. Well, that's been blown away, at least so far. And because of the resilience of this economy, and the employment has been hanging in there. And the key, if you listen to all the Fed discussions, the key to the interest rate direction and the speed will be employment. We'll see how that shakes out. Another thing is that historically, September, October is really bad months for the stock market, but there was no meaningful pullback this time. And so now, as we shift to December and January, the question is, are we going to have a normal correction? We think we will, and we'll talk more about that, but it's been shifted away from September, October, and perhaps it goes in to December or January. So there are some positives. We always like to put both out there. And one is that inflation continues to fall like a rock. And there's only a few items when you break down and get into the nitty-gritty of the inflation numbers. We're looking at housing, shelter, and we're looking at auto insurance. And so those are two of the big ones that are creating some of the higher than expected or not as much of a fall in inflation numbers. So there's just only two or three items that are holding up this inflation, but the rest of the inflation numbers, the different components, have been coming down like a rock. So it's just a matter of time between the auto insurance and housing or shelter starts to roll over, but we will see how that shakes out in the coming months as inflation comes every single month. So we'll see how that begins to hit the numbers. So the economy, the Fed, is still dovish. As we indicated, they are thinking about slowing down the pace, but they are still dovish overall, which is good for the stock market. And here's the big one. This is the big surprise, is the economy remains resilient. The consumer, at least up till Target started reporting, that has been resilient, and so is the economy. And another thing that's been very positive for the economy is the city economic surprise. It's been climbing. This is when anytime it indicates whether a number that comes out is better than expected or worse. And if it's better, it begins to rise. If it's worse, it begins to go down. So this is sort of a leading indicator. And so far, we've seen a surprise to the upside in the city's economic surprise. So the economy has been much better than most expected. In fact, many strategists today are expecting still a soft landing, or even now, some are saying there's not going to even be a landing. In other words, the economy is just going to stay robust. We're not in that camp, but we will see how this unfolds as we move forward. Another positive is the high yield spreads between high quality and low quality bonds. When there's trouble, when there's expected trouble, you'll see the spreads begin to widen, where you have to pay more for high yield because there's more risk of default because something's going wrong. Where right now it's very narrow. That's a good sign for stocks. And the other is the VIX. Now this can move very quickly, but currently it's below 20, which is considered risk on. And so the volatility measure VIX is still showing no signs of problems. And here's another one. Some analysts have now raised their S&P 500 year-end outlook to 6,300. We've touched 6,017. We're below that now. We're about 59.29, something like that today. But so we'll see if that happens. But everything has to be right for it to go to 6,300. But this is the highest number at the beginning of the year was 5,200. You can see how much has been adjusted based on the surprising economic numbers that have been coming out. Here's the other one that's positive. There's plenty of gunpowder on the sidelines. Cash is in abundance. So if some good news or some better news comes out for the stock market, there's plenty of money to go in and push that stock market up higher. So why are bond yields rising? Now, this is a surprise to us. We were expecting the treasuries to rally this year. They started to, and then they've now stopped and kind of pushed back the other way. And what we're seeing is all related to the economic surprise. The numbers for the economy have come in better. And this graph shows the correlation or sensitivity of the 10-year treasury yield to the economic surprise. And you can see it's towards the upper part of that graph going back to 2003, which tells us that the direction of the economy or economic surprise is highly correlated with where 10-year treasury yields are going. And of course, if we go to the next chart, we can see the blue, the economic surprise index, bottomed earlier this year, but has been surprising to the upside. And you can see now that it's more correlated, that the direction of the yields for the 10-year treasury has been going up. That's the gold line. And you can see the little blue dotted, but both the economic surprise, the economy is improving, but also yields are going up because of that. Now we think we're pretty close to the peak of the yield in the treasury bonds or in bonds overall. So our expectation is that bond yields are very close to the top in this reversal. And I think they're going to continue to get back on track to where we expected them to go this year. Here's another indication of the resilient economy. And this is economic fundamentals. This is looking at over since 2000. And this is the year-over-year change. You can see the historical average, which is the black bar, versus where we are today. You can see that the real GDP has been slightly better than historical since 2000. Real income, disposable incomes, even better. And you can see that the rates that have on fixed income and credit are lower than they were. And so, and nominal wages are higher, and then the CPI is lower. And that's what you want. You want rates lower and CPI lower and the rest of them higher. So this has been an amazing economy. In fact, if you compare the US to all the countries around the world, we are definitely the cleanest shirt in the closet. Our economy is doing better than any economy out there, and our stock market's doing better. So this is because of the resilience of the US consumer. And we're going to see what happens as we move forward. But we think these economic fundamentals are going to start to roll over as we approach the end of the year and into the first quarter. So what's happened because of this strong economy? If you remember towards earlier this year, most were expecting 6 to 7 interest rate cuts from the Fed. Well, we're down to just 3. And that goes all the way into the middle of next year. And then it's showing the expectation. This is our forecasting. This can change very fast. But right now, the expectation is for 3 cuts versus over double that earlier in the year. That's one of the reasons we put a position on in US 10-year treasuries, because of this high potential for the rate cuts, 6 to 7. However, it didn't pan out because the economy has surprised to the upside. So now it's been cut in half down to just 3. Now, this is a forecast, kind of an aggregate forecast, but Goldman Sachs in the next slide has a different opinion, and they're looking at 5 cuts through next year. And you can see they're expecting to go to 325 to 350. If that occurs, 10-year treasuries are going to do very well. And that's a 25% position in the equities that we have. If this comes to pass, which we believe it will, it's been temporarily on the sidelines, but we're still expecting this to happen. And that will cause a nice rally in the treasury market as we move forward. Now, here's, I've talked about labor is the most important thing. And where the Fed has their eyes on is what happens to employment. And you can see non-farm payrolls came out and it only was up 12,000. However, it was impacted. So this is sort of an anomaly. It was impacted by Boeing strike. It was impacted also by the hurricanes that we had, 2 hurricanes that came through. So that number, which will come out this very soon, that new number is the one we're going to have to look at as we go forward to see what is the actual number once we get through this noise in the data. But if this labor market softens, and it softens X natural disruptions and strikes, then this is where the Fed will become more aggressive and could cause bonds to rally even faster. So I want to look at seasonality and the stock market. This looks at 6-month periods, numerous ones. But I circled May, October. If you look towards the bottom, third from the bottom, you can see that is the weakest period historically. Now, this doesn't always come to pass. This data is from 1950, but normally May through October is a very weak period of time. And now November through April, which is what we're entering in now, is much higher, is one of the highest. It's the highest. Now, the question is, we did not have a weak September, October, or this period was not weak. So the question is, because it didn't happen this year, this period, is it going to be shifted into the November to April period? And we're looking at this very carefully. Are we going to have a weaker November to April than that's normal? Because we had such a good May through October, and we're going to see how all these seasonalities and the multi-factor economy that's out there and see how it pans out as we move forward. But this is very unusual what's taken place. And as I said earlier, normally you'll see a correction every single year in the stock market. We've only seen an 8.5% downside this year, which is minimal. So the question is, are we going to have a correction in December, or is it going to be next year? But it's very normal to have a big pullback, but we just haven't seen it this year. It's been very different than most years in the past. Another thing is the probability of a positive return. You can see that September, October are around 50% or less. And you can see the positive returns in November, December are very high. The question is, looks like November is going to be a good month. The question is December and what happens in January. So again, this is just another look at the seasonality and where we may be heading. Now, this is during election years, so this is a little different. It's not taking all the years, but in an election year, normally it's a good November, December past the election or during the election. So we'll see what happens this time. Is it going to be different or is it going to be the same? All right, here's the question that we're looking at every day. Is it time to be fully invested in stocks today? And what's interesting is the greatest investor in the world, Warren Buffett. I love this headline. This was in the Wall Street Journal. Does Warren Buffett know something that we don't? And the reason this was in the Wall Street Journal recently is because Warren Buffett is hoarding cash. He's not investing it. He's waiting because he thinks prices will be lower. Let's look at the next chart. So here's Berkshire Hathaway's huge amounts of cash. You can see the direction of cash has been, especially the last few quarters, has been exceedingly high. He's almost reaching towards $350 billion in cash. Very unusual. This is the most cash Berkshire Hathaway has ever had. So what does Warren Buffett know about the future of stock prices? Well, what he's doing is he's creating gunpowder to go in if there's a correction or even a bear market or prices come down significantly. So they are beginning, and they're going to continue to raise cash until they see better buying opportunities. In fact, Warren Buffett is not even buying companies that he already owns. Usually when he has this much cash, he'll go out and put more into the companies they've already selected and buy more shares. He's not doing that either. So he is raising cash. So my question is, what does he know that we don't? Or is something coming around the corner? Another sign of caution is corporate insiders and stock buybacks. Typically, when insiders have a good positive forecast for their own stock, they'll buy more stock with the expectation that they're going to have a higher price in their stock down the road. But what's happening today? We're seeing that they're not participating. The stock purchased by corporate leaders is not very high today. That's a sign of caution because they're the smart money. They're the inside money. What do they know? What does Warren Buffett know? Now, this is Amazon's Jeff Bezos has been selling billions of his stock. Meta's Mark Zuckerberg has been selling billions of his stock. We also have Jamie Dimon is cautious. Warren Buffett's cautious. And what this chart shows is the net buying is down very low from from 2015 and even before that. It's 2014. You can see it's down on the lower side. So what's happening is that insiders are not buying more of their stock. They're on the sidelines, similar to Warren Buffett. This is a cautious indicator. So what this is telling us that is something's going on that they think that maybe the stock market is too high in valuation, or they're going to wait for a better entry point in the future. Now, this is the elevated valuations. They'll leave limited margin for error. If everything goes right, it's okay to have valuations this high. But if you look, the word stretch valuation is right at that line, which is one standard deviation above the 30-year average for this is forward PE, not his trailing PE. This is if everything forecast goes right, this is what the PE is, which is normally lower. But you can see that we're above the one standard deviation, which means we're stretched valuation. And in that box, there's a number of valuation measures, and all of them are saying that things are stretched except for the earnings yield spread between triple BBA. You can see that last one. That's the only one. So the forward PE, the Shiller PE, all these, the dividend yield, price to book, all are saying this is a very price to cash flow. So we're seeing a number of measures that are showing extended valuation in the stock market. Again, It's okay if nothing goes wrong, but if something goes wrong, you'll see the PE ratio roll over very fast. Here's another sign of caution. Hedge funds, which is the red line, institutions are the black line, and then the retail is the blue line. And you can see that the most of the retail is margining up, but the smart money, the hedge funds, are shorting the market aggressively. This came from Goldman Sachs Prime Zero Hedge, and what it shows is that the smart money is shorting the stock market, which means they think the stock market is coming down. So there's a numerous cautionary tales here, and this is why we have a conservative positioning right now, and we think we're going to be rewarded as we move forward, and hopefully we're part of the smart money. Okay, I've been asked many times about, well, what about small caps or what about gold? Well, let's take a look at small caps. This is showing a small cap enthusiasm overdone, and there's been a recent rally, but small caps are still underperforming large caps by quite a distance this year, but they have narrowed that distance. But you can see the Russell 2000 and the 200-day moving average is reaching a key resistance area. It's been there before. And the question, can it break through that or not? But if you look in the lower chart, this is the small caps versus large caps, or Russell 2000 versus the S&P 500, which is a large cap. And if the line is going down, that means large caps are winning. Well, you can see the direction, this downward trend of small versus large. And so we have avoided small caps, even though they've had a recent rally, but they're the most vulnerable to higher interest rates. They're the most vulnerable to a recession or a downturn in the economy. So the best time, in our opinion, to buy small caps is when you're in the middle of a recession, because typically they're the first ones that begin to rally and work their way out. But this is not the time to be buying small caps, even though they're very inexpensive. The most reasons I hear is just the valuation of small caps. But this has been a 10-year drought in valuations. This is not a new thing. And there's a lot of reasons why I'm not overly excited about small caps. One is that with all the hedge funds and all the private equity funds that are out there today, they're buying up the good small caps. So they're not even in the indexes because they've been bought out. All the good companies are being taken out of the small cap index. So it's very difficult to get good companies to remain in the small cap indexes. And so much of it is being purchased by private equity firms. What about gold? Gold has been booming, but this is a longer term chart, and it shows a 60-40 portfolio, which is 60% stocks, which is the green line, and 40% bonds. This is not 100% stocks. This is a 60-40, which is conservative. And if you look at it has a 9.1% return since 87. And gold, which is the blue line towards the bottom, is only up 4.8. And of course, barely above a 3-month T-bill. But look at the volatility of a 60-40 portfolio versus the volatility of gold. You're getting almost double the volatility, but nowhere near the return. So what this gold has a specific time frame to own it. It doesn't pay dividend like stocks do or bonds, so you're not getting any income. So it's really a temporary holding spot if crisis is expected, and because gold normally will hold up very well if the economy or the stock market goes down. Now we can see that it's been running. I wouldn't buy gold today, and it's not the point we're making is it's a temporary position, and it's not somewhere to stay in and hold your money in gold. So here's our updated outlook. We've changed some things. We got phase one and phase two. We've delayed phase one because we thought this was coming early in the year, but the economy has been resilient. But we still expect the consumers to start to fade, and maybe Target is indicating it's starting with their outlook, Target stores. And then, of course, the economy would slow as a result. Households have been strained by high inflation. We're seeing that in a lot of different numbers today. Unemployment would rise, and this is the big one for the Fed. If that starts to happen, they're going to lower rates quickly. Corporate earnings start to disappoint the estimates. And then, of course, that all happens as a result of the consumer economy slowing. Then you have the economy falls into either a recession. I'm expecting this to happen. We thought it would happen this year, but maybe in the first quarter of 25. I believe it will come. And stocks, as a result, whether there's a recession or not, we do expect stocks to go into a correction or even a possible bear market. Underperforming stocks outperform tech stocks. Yields fall, bonds outperform stocks. Inflation reaches the Fed target. We push this out to 2%. That target will be hit early 25. And then the S&P 500 index drops to either 5,400 or 4,800, depending upon if we're in a correction or a bear market, somewhere in between. And then, of course, the wild card is the geopolitical event, which we've seen some tremors. We saw the Ukraine sending missile into Russia cause stocks to come down just for one day, but we saw bonds rally quickly. And of course, we have the Israel-Iran situation, which is definitely not over. So we have those potential wild cards. So that's phase, which we thought would happen earlier, has not. We were wrong on that. That's why we had that treasury position. But now we think we're in a good position, and we believe it's a very good time to own that treasury position where we are today, especially with people like Buffett and others, insiders, well-known insiders beginning to pull back on stock purchases. We think that's a sign of things to come. And we think this will unfold as we go through in towards the first quarter. Now, always, if this happens as we expect, then the market will start to discount an economic recovery. And this is where we want to shift out of bonds and out of our bond position and back into equities. And we like tech stocks for the long run. We like the AI story, and we expect stocks to outperform bonds. But we think right now what's in front of us in the near term, we think there's a growing risk for the stock market. And we think there's going to be opportunity in our bond position. And then, of course, our plan would be to exit that bond position at the right time. If the stock market does come down, if the economy does slow like we're expecting, then we will see what is happening in the market at that time to make the determination on the timing of going back into stocks at a higher degree. But that's our economic outlook and the markets. Thank you.
Fantastic, Tom. As always, thank you very much. Appreciate that in-depth, balanced approach and balanced analysis of everything that's going on. I would love to open it up to any questions that anybody has. So if you have a question, please do not hesitate to post it in the comment section of wherever you're watching from, whether it's LinkedIn or Facebook or otherwise. I would love to address any comments that you have. You're also invited to email me. I do have my email open here. I did have one question earlier, Tom. Give everybody a few minutes here to drop any other questions in. But one question kind of revolving around the consumer and the amounts of debt that we have and the debt that we're seeing, and just how ultimately the question is how can things still be holding up so well when we're seeing the levels of debt rising as much as we've been seeing, to your point, kind of the highest levels since the financial crisis. Any additional color to that?
Well, one reason is that credit card companies, and if you look, I'm getting offers to borrow money all the time, and what's happening is that the shift from government assistance is now shifting to credit. So what's happening is credit cards are being offered, and the interest rates are so high, some over 20%. Can you imagine paying 20% on your debt? And so what's happening is the people continue to spend, but there's going to be a D-Day that's going to occur, and that's where they have to pay this back. Or if we do go into economic slowdown, which we are expecting, then what will happen? They will not be able to make their payments, and this could be a snowball effect. But it's a matter of companies willing to borrow the money, and as long as the economy is good and it's hanging in there or it's above expectation, then this will be fine. It's just when there's a crack in the economy, then this will be compounded as it begins to unravel. So it's a very dangerous situation. And the other thing is, if you look at the debt loads, it's mostly in lower income, not the high income or the above average income. So most of the debt levels of the above average income or the high income is not excessive right now. This is all in the lower half. So that's the group or the population that would suffer especially if the economy turns down, because many of them will lose their jobs, and then they're going to have to go to a place where they can't make their payments. So this is kind of a risky situation we're all in, but it will impact everybody. So I think we're kind of in a dangerous place right now.
As kind of a follow-up to that, would you say, or do you have any evidence to support that the longer that this continues, the resiliency continues, the worse that result could be when those cracks do arrive?
Yes, especially if they keep offering credit to people at these high interest rates, and their debt levels continue to climb. And I would imagine there's people out there that aren't planning on paying these back. As long as they keep getting credit, keep getting money, maybe they're not planning to pay it back. And so and also, if this starts to creep up into the above average incomes, if it starts going to the higher income, if it starts creeping up, that would be a big problem.
Great, thank you. Give another minute here for anybody that has any questions to go ahead and send them my way, whether it's email or posting online. Let me take a look here. I think I might have another one for you. While I'm searching here, I will just mention a couple of things. The recording to this presentation will be on the website here in an hour or so. On the website, when that happens, you'll also have the ability to download a summary. So if you go to our website, go to the Capital Markets Update and Outlook page, you can download a summary here on the left. You can also ask a question directly in here. So if you're watching in the recording, that's another way you can ask a question. Would love to circle back with you on any questions that you have. Looking ahead, we heard from many of you last year that the holidays are a tough time to make time for these monthly updates. So we listened. We are going to look forward to our next Capital Markets Update and Outlook presentation, this presentation for January. And we are planning to do it live in person at Oak Ridge Country Club in Hopkins. So watch for details on that on the website and via emails. I'll also be mentioning it in my Monday update that I do every Monday morning. If you're not aware, I do start my week off 9 a.m. Monday mornings, streaming live on all of our different social media platforms. So if you'd like to join me on those, would love to have you. And then later on Mondays at 2 p.m., I send an email out to everybody on that list with a link back to that video. So if you're not able to join us live, Monday mornings has a link that goes out Tuesday afternoon or Monday afternoon. In that email, we also have our longer economic update for the week. It includes more than what I talk about on Monday morning. It also includes our weekly tax tip. So if you're not paying attention to that, you might want to, as tax season will be coming around the corner here soon. Most recently, we shared a few tax tips, like what to do if you get mail from the IRS, things to be looking out for as it relates to tax carryovers, military members and their families, and how they can get free tax advice. Also tax incentives that can help you further your education. So every week we have a new tax tip. So if you're not getting that email, you can subscribe, of course, on our website, investwithccg.com. With that, I will take a look. I think I did have another question here. So question for Tom. Okay, so Tom, what impact will Trump's agenda have on your outlook if Trump succeeds or fails with tax reduction, loosening regulations and restrictions, drill baby drill, ending the wars, DEI, cutting government spending, departments, etc.?
Well, the Trump presidency and, of course, Republicans, less government, less restrictions is all good for business. It's all good for the economy and stocks. So, however, that doesn't happen overnight. And it could be a year, 2 years, 3 years before it begins to unfold. So as we move towards the end of the year, next year, we will be able to evaluate that in a greater measure. But right now, it's impossible to determine how it will come out, how much they are able to get done. But it is positive for stocks and should be positive for the economy. But it all depends on, how long is it going to take before it actually begins to, we see the impact of all that they do and what can they actually do. The Congress is very thin. The House is very thin. So we'll see how much they can actually get done. But it takes a long time. It's like a ship coming into a harbor. They start breaking, 2 miles out or whatever the distance is. So there's a big delay between all the things they will or want to do and before we start to see it in the economy.
Excellent. Sticking to your guns as always, which I appreciate, and that is you're going to review the weight of evidence and analyze it as it comes in. So wonderful. I appreciate that question. For the person that I won't call you out on the screen here, but the person that submitted that question, we really appreciate you doing that. If there's any more, I'll take one last look here. I don't see any more coming in. If you're watching in the recording, as always, don't hesitate to send us a question. We'd love to circle back with you. So with that, I'll leave our theme up on the screen and close us out. Tom, any final thoughts, or are we ready to close it down for the year?
No, I'm very excited about what's happening and what's going to unfold. I'm cautious as we enter the new year, and just so you know, we are very much evaluating everything every day, and we're on top of what's happening in the markets and the economy, and we will be making adjustments as we go through and navigate through the times when they are changing.
Well said. Thank you very much, Tom. Appreciate you. Thank you all that joined us. I see a bunch of you out there today, so thank you for taking the time to be with us here today. And for those of you watching the recording, thank you as well. With that, I will sign us off. Hope everyone has a wonderful rest of your day and a wonderful holiday season. Talk to you soon. Bye, everybody.
Bye-bye.